Today, we are pulling back the curtain on something that happens every single day. Right after that closing bell rings, we're talking about after-hours trading. You know, the market after dark. So let's just imagine this for a second. The closing bell rings at 4 p.m. Eastern. The trading day is, officially over. But then, just 5 minutes later, a company you own drops a blockbuster earnings report. The news is incredible. So what do? Do you really have to just sit on your hands and wait until 9:30 tomorrow morning while the rest of the world is reacting? Well, the answer is nope. You do not have to wait, because as soon as the regular market closes, this whole other kind of hidden market opens up. So let's pull back that curtain on the market after dark and see what's really going on. That's right. Trading doesn't just hit a wall at 4 o'clock. For both individual stocks and those bundles of stocks we call ETFs, the action keeps going in these extended hours sessions. It's what lets people react to news that breaks outside of that normal 9:30 to 4 window. Now, what's really fascinating here is that for the longest time, this after-dark market was basically a private club, only for the big institutional investors, the Wall Street pros. But then, thanks to the rise of these things called electronic networks, the doors have been thrown wide open. Now, individual investors, people like you and me, we can get in on the action too. So to really get how this all works, we need to zoom out a little. See, the trading day that most of us think about is really just the main event. It's actually just one part of a much longer schedule, broken up into 3 totally distinct sessions. And here it is, the full picture. The day actually kicks off super early with the pre-market session, running from 4 a.m. all the way to the opening bell. Then you have the regular market session, the one we all know and watch, from 9:30 a.m. to 4 p.m. And right after that, the after-hour session starts, taking us from 4 p.m. all the way to 8 p.m. Eastern Time. It's a much longer day than you might think. Okay, but just because you can trade during these extra hours, it doesn't mean it's the same game. Not at all. Trading in these extended sessions is a different beast entirely. This night market plays by a very different set of rules. So the magic behind all of this is something called an electronic communication network, or ECN. The easiest way to think about it is like a digital matchmaker for stocks. Instead of routing your order through a big traditional exchange, the ECN just looks for another person out there and directly matches a buyer with a seller. It's fast, it's efficient, and it makes all of this possible. And this table right here, wow, it really lays out the crucial differences. During regular hours, you've got high liquidity and high volume. That just means tons of people are buying and selling. But after hours, both of those drop way down. That causes the spreads, which is the gap between what buyers are willing to pay and what sellers are asking for, to get much, much wider. And probably the biggest deal of all, it completely changes the kinds of orders you can even use. All right, this part is absolutely critical. In after-hours trading, you can only use limit orders. You can't just throw in a market order and buy at whatever the current price is. A limit order means you set your price. You say, I will not pay more than this, or I will not sell for less than this. It's a huge safety net that protects you from crazy price swings. But there's a catch. If the stock never hits your specific price, your trade just doesn't happen. And here's another key rule you've got to remember. If you place one of those limit orders after hours and it doesn't get filled by 8 p.m., poof, it's gone. It gets canceled. It does not carry over to the next morning session. You have to start all over again. So all of this brings us to what is maybe the most important part of this whole discussion, because while the power to react to news is amazing, it comes with some pretty significant risks. We're talking about big, big swings. This quote right here really gets to the heart of it. Just because a stock's price goes to the moon or crashes to the floor after hours, that doesn't mean it's going to stay there when the full market opens the next day. You have to think of after-hours prices as more of an early, emotional, and often very volatile reaction, not a guarantee of the future. So let's break down these risks. First, lower liquidity. That just means it can be hard to find someone to trade with at a decent price. That leads directly to higher volatility, where just a few small trades can send a stock's price flying up or down. Then you have wider spreads, which means the price you pay to buy is way higher than the price you can immediately sell for, which is an instant cost to you. And, let's not forget, you're usually trading against the pros, the big institutions with armies of analysts. So let me paint you a picture. A company reports fantastic earnings at 4:30. In the quiet after-hours market, a few excited investors push the stock up, say 10%. But overnight, the big institutional players, they read the fine print, they find something they don't like, and when the market opens for real at 9:30 a.m., they start selling. That stock could easily open lower than where it closed yesterday, completely erasing all those after-hours gains. It happens. Okay, that was a lot to take in, I know. So let's bring it all home. Let's make sure we are crystal clear on the key things to remember before you ever think about placing an after-hours trade. All right, here are the absolute essentials. Number 1, the big pro is that you can react to breaking news right away. 2, you have to use limit orders. It's your number 1 form of protection. 3, be ready for a world of low liquidity and high volatility. It is not the same as the daytime market. And finally, and I can't stress this enough, never, ever treat after-hours prices like a crystal ball for what's going to happen the next day. So we end on this question. The power to trade on news the second it breaks is an incredible tool. It gives individual investors a level of control they've just never had before. The real question is, now that you know the rules and the dangers, are you really prepared for the risks that come with stepping into the market after dark?